lecture that I'll add just to keep time. So what I want to spend today covering is Chapter 12. And Chapter 12 is one of the most important chapters. This is where we get into the number crunching and the calculation, that the basic fundamentals of calculating corporate tax. So I'm just going to turn the first slide that we have here is, this is basically just kind of like an update, some of the new developments. So of course, you know, as a tax professional, we have to stay on the ball. We have to be following up with the constant every year changes to rules, changes to rates, and factoring that into our clients' tax plans. And really, tax planning is an annual process, if not more. But at minimum, something that you want to look at every year and amend the plan as appropriate for the current rules. So something that has been kind of a current development here in corporate tax has been an increasing small business deduction, which effectively means a decreasing corporate tax rate for those who qualify. So the small business deduction, and just, you know, if you had me in tax one, which I know many of you did, it kind of bugs me it's important to me, the difference between a deduction versus a tax credit, right? We know those are two very different things. One reduces your income that you're going to be taxed on, and one reduces the actual tax payable directly. The tax credits were often at 15%, right, for personal, and the income reduction could be as high as 54% for personal. So two totally different things. Flash forward now, you're with me in tax 2, and we have something called the small business deduction. Well, we're going to get into this in detail today, but I would first like to report that this is not a deduction as we would have learned it before. It's not a deduction from income. It's a reduction in the tax, effectively the tax rate, but really directly in the tax payable. So in other words, it behaves as a tax credit. We're going to go through those calculations tonight, so you'll see how that works. So as this small business deduction tax credit, if you will, as this has increased, it is now 19%. That decreases the effective corporate tax rate. So we went from 17.5 to 18, and now all the way up to 19%. That is a 19% reduction in the tax rate that you will pay effectively for the corporation. We will get to these TOSI rules. That affects corporations in that the owners of the corporation have limitations to how they can spread their income out and decrease their personal tax rates. And we also had some developments here with passive income. So starting in 2019, amounts in excess of $50,000 will result in a reduction in the annual limit for small business deduction. So this stuff, we haven't really learned any of it yet. So these might not mean anything to you yet, but that's some of the current developments. Really, it's just a highlight that these things are constantly changing. We got to keep our finger on the pulse of tax here to properly give advice to our clients and properly prepare their tax plans. So we're going to learn about all of these, items. Specifically, the small business deduction is a very important topic under this Chapter 12 heading. Excuse me. So one of the important schedules that we are going to learn about here in Tax 2 is called a Schedule 1. Now, there used to be a Schedule 1 in personal tax. They've now merged that with the T1 General, but it's a similar sort of idea. The Schedule 1 makes some adjustments. So we start with accounting net income, right? So you just take that from your financial statements, right? So you get the company financial statements, and then we have to make our adjustments. We have to effectively translate. We're going to take our accounting income and we're going to run it through a translator and turn it into net income for tax. That phrase should be familiar. It's the same phrase that we used when we talked about personal taxes. In personal taxes, we were adding all the different income sources together into one pile, and we called that our net income for tax. We have to do a similar process here where we're taking our accounting income, we're running it through the translator, right, for all of our Income Tax Act rules, and coming up with net income for tax. That all happens in the Schedule 1, which is part of your T2 corporate tax return. So again, we did T1s for personal. In corporate, it's called a T2 corporate tax return. So we pull out our financial statements and we have a whole bunch of additions and deductions that we're going to do to translate that net income. And this is what we are looking at. First, we're going to add some things to net income. Well, the first one on the list should be a real no-brainer: income tax expense. Income tax expense is not deductible, so we're going to add it back. So that's what we're talking about here when we're adding things back. We're adding things that are not deductible. That's why we're adding them. So in other words, you have a set of financial statements. Financial statements, they have revenues minus expenses, right, to get net income. If there's something in these expenses, right, that's been deducted that isn't tax deductible, we start at net income and then we just add back all of these items. So when you're getting to net income on the financial statements, you would have deducted income tax. Can't deduct that to get to net income for tax. We got to add it back. Likewise, amortization, depreciation, depletion, those are accounting terms. We don't deduct those. We learned, what was it, Chapter 5 back in Tax 1. We learned about our friend CCA, right? So remember that stuff back in Chapter 5? Well, that's coming back around. So Chapter 5 and Chapter 6 of Tax 1, we learned a lot of business concepts. Those concepts carry forward to Tax 2 when we're talking about a corporation, a business, and its corporate tax return. So CCA is what we can deduct for tax. So we have to add back our amortization. That is not what we can deduct. So again, this is just a list of additions. In a moment here, we're going to talk about what the deductions are. So we're adding back things that are not deductible for purposes of tax. Income tax, add it back. Amortization, add it back. Recapture of CCA, add it back. We're going to talk about reserves from prior years, add it back. Losses on disposition of capital assets, that's going to be an accounting calculation. We have to add that back. Remember, this is going to be pulling from a little bit of your Chapter 8 knowledge. Remember that only 1/2 of capital losses and capital gains go to your tax return. But on a set of financial statements, you're going to have the whole amount, right? The real actual gain or loss. So the accounting version of that loss has to be added back. Now, don't forget, we're going to deduct things on the other side of this. Some of those marry up with these items. Pension expenses, the accounting amounts. Research and development, the accounting amounts. Warranty, same thing. So for some of these items, there's an accounting version of the expense and a tax version of what you can deduct. So all of these accounting things are getting added back as we run through our translator here to get to net income for tax. We're adding back what we don't want to use, all these accounting things, and we will replace them with the proper tax versions. Debt discount amortization, foreign taxes paid. Foreign taxes paid may come back around as a tax credit, but for purposes of this, they're not deductible. Excess of taxable capital gains over allowable capital losses. Interest and penalties on income tax assessments. So this would be an example of something that's just 100%. That's just a no-go. Interest and penalties on income tax. If you paid your taxes late, or if you filed your taxes late and you'll get a penalty from CRA, that's just a no-go. They're not going to give you a deduction for that. So this is one of the ones where we're getting rid of the deduction by adding it back, but you're not going to replace it with anything. It's just not deductible. So something that was subtracted in getting to net income on the financial statements would have to be added back in order to get to our taxable version of this income. A similar one here would be business meals. We can only deduct 1/2 of business meals. Therefore, we have to add back 1/2 of the total cost. That's just kind of the mechanics of how it's done. If you have deducted 100% and then we add back 50%, we're effectively deducting only 50%. So your financial statements are actually reported on as they are two of the schedules in your tax return are effectively your financial statement information. So you're categorizing all of your expenses and revenues, assets, liabilities. You're reporting both your balance sheet and your income statement on the T2. This is unlike what we learned back in Chapter 6. We were talking about the T2125. All you kind of had to pull together was a little revenue and expense, kind of an income statement. When you have an incorporated business, you have to report everything. You have to have a full set of books, balance sheet, income statement. You have to do proper accounting. You can't just keep a little spreadsheet, double entry, debits, credits. the whole 9 yards. Another one, so this was a big no-go. Unfortunately, club dues and the cost of recreational facilities, that's also a no-go. That means no golf. Sorry to the golfers out there, but no, you cannot deduct your golf. No green fees, no memberships, none of that. If you go to the restaurant, the clubhouse, and get some food with a client or something like that, you could deduct 1/2 of that cost effectively. Now that expense could be reported as an expense for your business and shown as an expense, reducing your net income for accounting purposes, for your financial statements. If your company says, we need this membership, we're going to pay for it, you're going to meet with potential clients there and yada, yada. That can be an expense on your financial statements. However, it will not be deductible for tax purposes, and it will have to be added back. In addition, there'd be some debate there if this could potentially be very often. It's definitely going to be looked at as a potential taxable benefit to the employee as well, or a shareholder benefit if it's a shareholder. This also, for the non-golfers out there, for the folks who like to work out, this also includes the gym. That would be a taxable benefit and not something that can be deducted for tax purposes. So if you're a small business owner with an incorporated company and your corporation's paying for your gym membership or your golf membership and you're deducting it, if that was audited, you'd likely have the deduction disallowed and on the flip side, have a taxable benefit personally for that payment. I've seen that many a time. They always look for that stuff when doing a corporate audit. But in particular, this comes up a lot in, say, a corporate audit or payroll audit. They're looking for benefits that employees or owners may have taken and not reported. We have, what else we had? We got non-deductible accounting reserves. We'll talk a little bit about that stuff. Charitable donations. We will discuss how and where that gets handled. Sometimes something might get added back in order to calculate net income. Remember, we're calculating net income for tax. Remember, we always have another number, which is taxable income. There's going to be some similarities here to what we learned in Tax 1 with that. We're just doing it now for an incorporated entity. Asset impairment write-downs, fines and penalties. Generally speaking, if you've been fined or penalized somehow for breaking the law, they're not going to let you deduct that, same as interest and penalties. They will allow you to deduct interest on other bills. You pay your utility bills late and they charge you a little interest on there. Or even if you paid like a property tax bill late and there was interest on it, that kind of stuff is fine. But CRA interest and penalties and any kind of legal fines and penalties, those will be a no-go. So you add them back. So far, so good. Anybody have any questions on those add backs? As always, if you guys have any questions at all, feel free to just dive in, hop on the mic, or pop them into the public chat there or private chat or whatever, and I'll try to address them as fast as I can. I've got a little chime that goes off there when a chat gets posted, so I'll try to answer those right while we're in the middle of discussing it. So that was a list of examples of things that we would add back. On the flip side, we have stuff that we're going to deduct. So again, we're starting with accounting income right off the financial statements. And then we're going to add some things back. Right, so we're going to have these adds, and then we're going to have some deducts. These are the deductions. When we did the additions, you will recall we had amortization was something we were adding back. We are going to replace that with our old friend CCA from chapter 5. So we would add amortization and instead deduct CCA. That's how we translate accounting income into net income for tax. So really, that's the mechanics. Add back the one that was used, deduct. Add back the accounting version, deduct the tax version. That's the translator to get from accounting to tax. So CCA is a good example of one you're always going to have. You're always going to have some amortization to add back and some CCA to deduct. 99% of businesses have some equipment of some sort, at least a laptop, a desk, something that's been capitalized and amortized over time. For incorporation costs, we have a limitation on what can be deducted. So the first $3,000 of incorporation costs can be deducted. We can talk a little bit more about that, but we're just going to kind of keep going through the list. This is just kind of a quick, here's the types of things you're adding and deducting. Terminal losses. Again, if you need a refresher, we learned about those back in chapter 5. Deductible reserves. Gains on dispositions of capital assets. So we are going to deduct the accounting gain and add the taxable gain. So remember, if we have a capital gain, that's going to be sitting on the financial statement. So we are going to deduct that entire capital gain, and then we are going to add back 1/2, which is the taxable capital gain. So one thing I'll note here, the way this is exactly as the form as Schedule 1 works. It's very deliberate. Here's your accounting income. Add this, add this, add this, deduct this, deduct this, deduct this. So you want to make sure that, so this capital gain, this is on your accounting financial statements, right? So that number is going to be at the top. You're going to show a line for subtracting the capital gain, right, per the financial statements. And then you're going to show a line where you're adding 1/2, which is the taxable portion of that same capital gain. So you don't, I get it, effectively, these two, subtract the whole plus 1/2 is effectively subtracting 1/2. That's what it effectively is. But when you're answering questions, just like the way the forms work, they're very deliberate. Show the full gain subtracted and show the taxable amount added. Show all those levels of detail. Don't try to kind of shortcut it and subtract 1/2. We want to mimic how these forms work. And this is all, again, part of your schedule number 1. We have a few more on here: pension funding contributions, deductible R&D costs. Again, we mentioned, here it is, we mentioned R&D costs, the accounting version. There can be, like, basically what this is getting at is maybe the R&D has been spread out over a different schedule than what you're deducting for tax. It might be that the tax deduction is on a different schedule, it might be faster. There's going to be an amount that you can deduct for qualifying R&D. And we got a few more. Warranty costs, debt premium amortization, foreign non-business tax deduction, allowable business investment losses, and this one's a weird one, randomly, landscaping costs. This one is kind of an oddball. A lot of companies would kind of capitalize, saying that these landscaping costs will be of value to the company for 5, 10, 15, 20 years or whatever. For purposes of tax, you can deduct the whole cost when it's incurred. So it'd be capitalized for accounting purposes, but deducted for tax purposes. So that's just kind of a little bit of an oddball one. So again, we start with our financial statement accounting income. We run it through the translator, all of these adds and subtracts, and we get to net income for tax purposes. I'm just gonna bring Schedule 1 on the screen here just to show you guys what I'm talking about here. So just like we've been talking about here, so this is it, Schedule 1. This is a part of your T2 corporate tax return. And tax returns, again, you have that kind of T2, the general part, just like a T1, and then you have all these offshoot schedules where other things are calculated. So Schedule 1 being, one of the most important ones here, just like we said, starts with net income or loss after taxes and extraordinary items from your Schedule 125. Schedule 125 is basically your income statement using what we call GIFI, General Index of Financial Information. That's where every kind of line item in your income statement and balance sheet gets a code number, so they can kind of pull all that information together and run their systems, get comparable information. Basically store up all that information for statistical purposes and, also probably to try to get red flags for audits, surely. Companies in this, you have to report what industry you're in, what type of company you are. And, they say, well, companies in this industry normally have 5% of sales as this certain expense category, but you've got 35%. Why is that? That sort of thing. They can pull information like that. So that's Schedule 125. That's basically your income statement. You feed that in from your financial statements and you get the number right here. So let's say you made $100,000 for purposes of accounting purposes from your financial statements. Then line by line, just like we've been talking about here, line by line, we add things back. We add back our provision for income taxes. Again, obviously, income taxes themselves are not deductible from income taxes. No brainer. Add them back. Amortization. That's not for tax purposes. That's accounting. Add it back. All this stuff. Recapture of capital cost allowance. loss on disposal of assets, all the accounting versions of these things. Add them back. So this kind of gives you all the options, and there's probably more here than what we discussed. Non-deductible life insurance premiums. So you add all this stuff, go to the next page, and then we hit deductions. Gain on disposal of assets per the financial statements. So that gain would be 100% of the gain. We have to deduct it, but instead we add where are the taxable capital gains. Now this feeds from another schedule because you're going to give more details about it. But you see, basically it's like that. We're taking away, if it's a positive thing, we're taking it away and adding the tax version. And if it's negative, we're doing the opposite. We calculate all that out. You get net income for tax purposes. So that's just an idea of what that looks like on the actual forms that you'd fill out in your tax return. Now, the good news is that our software, as we're entering all the information into Giphy, into the Schedule 125, it's going to populate the basic stuff here that is really obvious. If you filled in meal expense, it's going to come over here and fill it. Now, there are additional rules, though. You can't just have the software do everything for you because there's certain things the software can't know. When it comes to those meals, that's a general rule that only half is deductible. But there are some more complex rules and some scenarios where you would be allowed to deduct 100% of certain meal expenses. So then you'd have to go in and adjust this amount manually based on your calculations of that. So this isn't always perfect. I mean, the software doesn't always do all the work for you. That's how I should kind of phrase that. Non-deductible club dues and fees, Good Life Fitness, golf membership. That's where you'd add it back. Non-deductible meals, the 50%, whatever it works out to there, all that kind of stuff. If there's expenses that are deemed to be personal, add them back there. So this, you might recognize this little list of items. These are probably somewhat familiar as our little Division C deductions that we talked about there back in Chapter 11, many of these. Lifetime capital gains deduction. That does not exist for corporations. So you're not going to find that deduction between net income for tax and taxes payable. Doesn't exist. Employee stock option deduction, no. Lump sum payments, no. These things, Northern Residents, social assistance, no. These are all personal. So those guys do not exist in the corporate world as a deduction. How do we get from net income for tax to taxable income for a corporation? So we still have to do that process, just like we did for personal tax. And it's the exact same concept in general, just done a little bit differently. The net income for tax is meant to represent the current year regular income type stuff. And it's going to be used later to calculate some benefits. So we don't want people to be able to fiddle with it, and change that in any way. You can go ahead and do your fiddling here to get to taxable income, but we want to have another more normal income that doesn't factor in things from prior years and other weird stuff like that. What's that weird stuff? What's that? For corporations, it's losses, right? So that's the same stuff we talked about in Chapter 11, our carryover losses. We're not talking about current year losses. Current year losses would be applied right away. Like a current year capital loss will immediately be applied against any current year capital gains to the extent it can, and then would be carried forward. So the carryover losses of other years being brought in to decrease net income, or sorry, taxable income, is what we're talking about here, to get from net income for tax to taxable income. This one's a little bit of a different one for corps. Charitable donations. This is a deduction for corporations, not a credit. We learned about calculating it as a tax credit for individuals. Well, for corporations, it's different. It actually is a deduction that reduces your taxable income. You will notice a few slides back. Where did it go? Right here. We added back charitable donations. They said, well, why would we add it back? And then we come here, we didn't have any matching deduction for it. How come we didn't get to deduct those? What were we going to do? Well, turns out it's not because we're going to use it as a tax credit. We are going to use it as a deduction, but it happens in here, in between net income for tax and taxable income. We have to be able to calculate a net income for tax in order to determine how much donation we're allowed to have. We have to take that charitable donation itself out of that calculation. We also have other things we need to calculate, benefits, I'll call them, and we don't want people to be able to change that around intentionally with donations. Lastly, we have dividends. A corporation can receive dividend income. That dividend income often is income that has already been taxed at the corporate level. We're moving it from one corporation to another, so we're not going to tax it again in the hands of the next corporation. You imagine if you had a row of 5 corporations, and every time they paid a dividend to the next one down the chain, they paid the tax over and over and over again until there was no money left. When the dividends go from corp to corp, they don't get taxed again. So we will deduct them. So we'll talk about that in a little more detail as we continue on. These 3 are the big 3 items we're going to deduct to get from net income for tax to taxable income, which of course is the one we're going to multiply by our tax rates. And we'll learn how those rates work. It's not a big bracketed system quite like personal tax. It's a little different. So we're going to look at that. So this was just a little example talking about the dividends. If they're going from one corp to the next, you know, you keep paying tax on them. This little example saying, you know, now you're at 51%. When the corporate tax rate in this example, say, is 30. So the solution so that that doesn't get double taxed is to simply allow the corporations to deduct, this is important, taxable dividends, meaning they've already been taxed. So taxable dividends received from other taxable Canadian corps. So normally they would be taxable, but they're going between 2 Canadian corps. So we don't want to have that charged over and over again. So this does not include stuff that would come from foreign sources. Does not. This is specific to Canadian corps. I'm just going to skip through a few of these. We don't need to get deep into these yet. So what I was just mentioning, foreign source dividends, they're not deductible. There's some exceptions mentioned in our international taxation chapter, but generally speaking, not deductible. So all you guys need to worry about is it's just the Canadian ones that you'll deduct. Now, remember, there is a difference between a deduction and a tax credit, right? So these foreign source dividends are not a deduction. However, they can be a credit against your tax payable because you've already paid some tax. We talked about that for individuals in tax 1. If you paid if you're a Canadian resident for tax, but you earned your income in another country and paid some tax there, generally speaking, you can get credit for that tax payment, and you just have to pay the additional percentage on the Canadian tax. If that country taxed you 20% and Canada would tax you 30%, all you have to pay is the additional 10 to top up to the Canadian total amount. So it's kind of a similar concept here in that we're going to give you credit for what you paid, but we're not going to give you a deduction. So we spent chapter 11 refreshing and talking in more detail about losses, non-capital, net capital. We talked about all of that stuff. So same thing for a corporation. These taxable capital gains and allowable capital losses from the year have to go against each other. We're going to get into some examples of how this all works. So we'll just keep going here because we're going to get into some examples from the text. We'll go through a text. We talked about these losses. Let's see here. Okay, let's get to this part here. So the topic here is the geographical allocation of the corporate income, right? So where's it being earned? Revenue, salaries and wages. What we're talking about here is allocating, a method of allocating income to provinces. Well, why would this matter? Similar to personal tax, for corporations, we pay federal tax and provincial tax. So you have two components to your taxes, just the same as we would have done for personal tax. But what if, so it's a Canadian corporation we're dealing with, so they're going to pay federal tax in Canada. But what about provincial tax? If they're operating in multiple provinces, how do we determine how much they're going to pay for provincial tax? So it's actually quite a simple calculation. Basically, you line up the biggest items you probably have in your income statement. So you line up your gross revenues by province. So where did you earn that money? Where were those sales? And figure out the percentages of each. So in this example, 25% of this company's gross sales, before any deductions, gross revenue, happened in Alberta. Their wages in Alberta were 20%. So we simply take an average of those two percentages. It's actually a shockingly simple calculation. So province by province, you figure out the percentages for revenue, the percentages for wages, then you take those two percentages. In this case, it was 20 plus 25. You divide them by 2, equals 22.5. It's a shockingly simple calculation to determine how much of your income to allocate to a province for purposes of the provincial tax. So this company in this example had $1 million in revenue, 500,000 in wages, and they had 100,000 of taxable income. So the taxable income gets spread out in these percentages. So there's our total income, and each of these numbers will be multiplied by the provincial tax rate. Now that can be very, very important because we have significantly different tax rates by province. Nova Scotia is one of the provinces that is on the higher end of the tax rate spectrum, same as we learned in personal tax. We're on the high end. So certainly properly allocating out the provinces can make a big difference in the total tax bill. So again, Ontario, it was simple. It was 35 plus 40 divided by 2 equals 37.5. That's all we did there. Nothing too magical. And of course, all these percentages here are going to equal out to 100 in total. And all of the allocated amounts are going to equal out to 100,000 in total because that's what our taxable income is. That's just given here as an example. We didn't calculate that. We were only given two pieces of information: salaries and wages and gross revenue, which is obviously other expenses. So you could assume, for sake of argument in this question, you could assume, fixed expenses were 400, like your overheads or whatever were 400K, just as an assumption. That's how we got to the 100,000. So now let's get to calculation of the federal tax payable. So step one in figuring out our corporate tax payable is to go from your financial statement income to net income for tax to taxable income. And then we take that taxable income and we're going to run it through our rates. But this is very different than how we did that with personal tax, the personal tax rates and tax brackets in tax one. We have a whole different system here, and effectively what we end up with is basically just two tax brackets. But that does not really mean necessarily that this whole thing is more simple. It just means it's different. So the way that you will do these calculations is that you will calculate chunks of the tax one by one, starting with the highest amount and then slowly reducing it. So the first part of the tax is going to be, and this is just federal, this is not the provincial. So the first part is going to be your basic rate. This is going to be the highest number on the whole thing. It's 38%. I think so if we did a really simple, which we're going to do here, example, on 100,000, your basic 38% of 100,000, you start by calculating 38,000 of tax. Then we slowly decrease that number. Then we add the provincial part. So this was federal tax. So we start with our basic 38%. And then we slowly reduce it with whatever we have to use to reduce it. So that's what we have to kind of figure out. Oh, and by the way, check this out. Bingo. Look where we sit. This is for general. Remember I said there's two brackets? So general or big business, and then small business. Nova Scotia, 16% and 3%. Look at that big 16. That's the additional tax you pay. If for your income that is not, these are big, you can call these your two brackets, if you will. So you might pay some tax at the small business level and some tax at the big business level. We're going to get in tonight into the complexities of how that works. So it's sort of like two tax brackets. Nova Scotia, 16% for the big, 3% for the little. And if you compare that to other provinces, like look at Quebec, Ontario, BC, Alberta, we're paying significantly more on a percentage basis. Also significant here, so significant that we are really high. Also significant, we have the biggest difference between, so we have the largest spread, if you will, or difference between the big versus the small. That means classifying income here under small is going to mean big money. 13%. We're going to learn about a $500,000 limit. So $500,000 multiplied by a 13% difference on just the provincial component. That's $65,000 alone, just provincially. So there's big money on the table here for, small privately owned companies to make sure they're properly qualifying. And we're going to learn all about the different intricacies of qualifying for the lower rate on that first 500,000 of income. So back to our calculation. Step 1, 38% of taxable income. Step 2, we're going to take a reduction of 10%, which is called the federal tax abatement. How nice. A little 10% gift, a break from the federal government. Why would they do such a thing? Well, they are doing this only if the income was earned in a province. Reason being, because if you earn it in a province, that means you're going to pay provincial tax. They're giving you a little bit of space, 10%, so you can pay your provincial tax. If you don't pay any provincial tax, then they're going to just take the full tax rate. You'll notice our tax rate is 16%, potentially. So that doesn't really get you all the way there, to say the least. Not for any of these provinces given here. So that's step one. Starting with our basic countrywide rate of 38%. And by the way, as an example, you say, well, you must have earned it in a province. Well, maybe not. Maybe you're a Canadian company. Maybe you earned some of that money in the US. So you would get no abatement if you're earning it in the US. If you're giving some of that money to a province, perfect. Less payouts the federal government has to give the province. So we'll give you a little tax break. Next up is what we call, it's going to show up here as GRR, or general rate reduction. This one is 13%. And that's going to, so you're dropping, what we're talking about here is 38 minus 10 minus 13 more. So you could be getting all the way down to a federal rate here at this point of 15%. That's the general rate reduction. Now, all of these elements are described in your text. This is federal abatements on 594. Well, the basic rate starts on 593. 594 is the federal abatement. And the general rate reduction is right after that on page 594. This one's a little bit of a weird one, if not the whole thing is weird. This is this is the spot where the government can change this. They don't change the basic rate, but this rate reduction is something in theory that they can play with. So this would be where they might, if a change was required, they could just increase or decrease that rate reduction. This would affect, this would affect the percentage that is going to be charged to your, let's call it, full rate taxable income, because it's hitting specifically the general rate, not the small business rate. So you'll notice we haven't talked yet about our small business deduction. We talked about how that was up to 19%. That's something else. We're going to talk about that after our break. So the general rate reduction is for people that are paying full rate taxable income. If you're getting small business, you don't get this. So you're not going to get both. You're going to get one or you're going to get the other. You don't double up on this one. So when you're doing a question, well, obviously this wouldn't even work out if you were 38 minus 10 minus 13 minus 19. Well, now we're into the negatives. It's not going to work that way. So this is a one or the other scenario. It is 6:44 right now. That's probably a good stopping place, right? This is the simple example using what we talked about, 38 minus the 10. If we don't qualify for small business, we get the general rate. Everybody gets it. This, all it has to be is income that was taxed at the full rate. It's going to get reduced 13%. There's your federal tax. If your province was at 12%, right, say it was BC, you earned this in British Columbia, so that's what we'd say this example is in BC. For sake of argument, you pay your additional 12, so your total tax is $27,000, effectively 27%. This was a company, this example, we're going to say they were in BC and they did not qualify for the small business deduction. That's a very simple version of this calculation. We'll continue to look at this and add more wrinkles as we get past the break. So let's take a 15-minute All right, folks, let's get started again. So we left off with a basic calculation here of corporate tax. We got to our taxable income of 100,000, and now we're running it through the calculations. In our example for BC, we ended out at 27%. They didn't qualify for what we call the small business deduction. They're paying the full corporate tax rate. So we know, we've kind of learned this along the way, that there's going to be special incentives built into our tax act. These incentives for corporate tax focus around small business. They focus around certain business activities. So that could be, historically, first of all, let's use this example, something like manufacturing. I scribbled that, but you get the point. Manufacturing historically has had some extra benefits because it's in theory, job creator. So let's make things easier on manufacturers. Small businesses also looked at as a job creator, an engine of the economy, plus a little less able to pay. Let's give them a chance to be created, grow, give them a break. Incentives for certain regions, certainly, is the money earned in Canada, right? So Canadian, small, active. These are kind of the three things you'll be looking for. Is it small? Is it active? Did it happen in Canada? Then you're going to be taking advantage of things. If it's an active business, such as an example, manufacturing, then it's going to be, in theory, a job creator, more so than a, say, passive income like an investment. And of course, we have integration as a general goal, which we can discuss. That's simply talking about, if you're paid directly as an employee, or sorry, I should say, if you directly earn the money versus if you were paid it through a corporation, are you going to pay the same amount of tax? A perfectly integrated system, there's no difference. So those are some of the goals of corporate taxation. Integration, we're going to pick that up, talk about that in chapter 13. So we'll pick that one up in the next chapter in a little more detail. So let's talk about the small business deduction, and then we'll get into a sample question, start crunching some numbers. So what is the objective of the small business deduction? Well, obviously to give relief to small businesses, to encourage active business investment income, active business income investment, to provide for the accumulation of capital in a new business. So they're saying new businesses will have a better chance to grow if they spend more of that money reinvesting it in the business, an active business that creates jobs in Canada. That's what we're looking to encourage. So we're going to give relief to small businesses in order to give them the chance to grow. That's the objective. All of these tax rules at some point had an objective and a reason for being put in. Do they always achieve that? Sometimes yes, sometimes no. A lot of the time, somewhere in the middle. So how are we going to qualify, or what are some of the basic concepts around the small business deduction? Well, first of all, this is only available to CCPCs. If you're looking at a question and it tells you that this company you're dealing with is a publicly traded company, you will not calculate a small business deduction. So keep that in mind. If the company is public, there will be no small business deduction. So make sure you know what type of company you're looking at before you go and just start calculating deductions that they would not receive. This is related to active business income only. So, by the way, Canadian controlled private corporation, that, just a second ago here, we were talking about small active Canadian. That's what we're trying to have incentives for. So small and Canadian, if it's Canadian controlled and it's private, that's going to cover Canadian and small. Second here, it only relates to active business income. So another no-no here is passive. We're not talking about passive income. So not public, not passive. Let's do this consistently. Not public, not passive. Remember that. So active business income. Not passive income would be something like investment income, rental income, to a certain extent. We will talk about exceptions. But active business income, you got a shoe store, you got employees in there, they're selling shoes, you're stocking the shelves. That would be an active business income. A cafe, customers are coming in, you're selling coffee, you have staff, active. You're actively working to earn the income. If you have a corporation that has an investment portfolio and it's earning its money off the growth of that investment, that's not an active business. That would be passive income. The reason why we're trying to give incentives to active income, again, because that creates jobs. Another component of this is the annual business limit. This is the $500,000 that I was talking about. This $500,000 is the most you can possibly, the most income, right? This 500,000 is 500,000 of income. We're going to talk about that specifically, but 500,000 of qualifying income that you can use this deduction against. That's the max. All right, so that's your maximum. We will learn in Chapter 14 about the associated companies or associated corporations rules. If you are deemed to be associated, you have to share the $500,000 limit between your companies. So in theory, if you had 4 associated companies, maybe they have to share 125 each, or maybe it's based on an agreement. So maybe 2 of them each use 250 and 2 of them use 0. Maybe they don't need it. Maybe 3 of them don't need it and one's going to use the whole 500 amount. You get to make that group of associated companies would come to an agreement of how they're going to share that limit. In Chapter 14, we'll get into the nitty-gritty of how we determine if corporations are associated. So let's look at that same example, but factor in a small business deduction. So we do our 38%. That's our basic rate. We take away $10,000 because this example, we're assuming it's a company in BC, so they've paid provincial tax. Like, we'll keep with that. We'll say they're in BC. Or actually, no, sorry. We switched. 3%. Nova Scotia. We're home. Well, home for me. I don't know where all you guys are right now. So we have the federal tax at the 38. We get our abatement at 10. In this example, we're assuming Nova Scotia. So home here for 7 out of 10 of us at least. Or maybe not home, but where we are right now. So Nova Scotia, 3%. So we're going to start with the federal piece. So we get the abatement because the income was earned in this example in Nova Scotia. All of it was. Again, just kind of a simple example. So that gets us to 28. This company, we're going to assume, does qualify for small business deduction. So we have these items. We're talking about a CCPC with active business income. They have limit available to them, all that good stuff. And there is more to it, but we'll keep going. So they get to reduce by a further 19%. 19 times 100,000, it's 19,000. So you'll notice what we're doing here with the calculation. We actually write down 38,000. We reduce it by 10, like we're doing the dollar value. This isn't like 38% minus 10% minus 19. You actually line by line calculate the dollar value of the tax. So when you answer your questions, don't kind of shortcut it and do 38 minus 10 minus 19 equals multiplied by 100. Show it explicitly like this, line by line, because again, that's how it looks on the tax forms. So we want to match all of that up. And then, so that gives us here at a small business rate, we're going to pay 9% federally. We're going to add our 3% because not 16. We're going to go with 3 because if you qualify as small business income federally, you also get the small business provincial rate. So this is the reality of where we're at right now for 2019 taxable income. We are at 12%. So this example is factoring in 2019 taxable income. In Nova Scotia, 12%. So really, it's a pretty half-decent corporate tax rate. We will talk in Chapter 13 about the whole integration of paying your corporate chunk of the tax and then your personal part of the tax if you as the investor take the money out as the owner of the business. But as far as a direct corporate tax rate, 12%, including provincial, looks a heck of a lot better than, say, a federal rate of 38% plus 16%, right? You'll notice this 38 federal plus, if you were at the high 16, that would be 54% in theory, if you did not qualify and you did not earn the income in a province and all of these other things. So that would be worst case scenario. But over here, small business income earned through a corporation in Nova Scotia will initially be taxed at corporate 12%. Now, what about this property income or this passive income? So generally speaking, if what I mentioned before, if the company is specifically just a passive earning vehicle, they're likely to not qualify for the small business deduction. There are some exceptions. So these would be called specified investment businesses. They do not qualify for small business deduction. But there's exceptions. Businesses with 5 or more full-time employees get an exemption from that. So even if the income is mostly passive, as long as they meet that threshold of 5 or more full-time employees, then they're not considered a specified investment business, and they can potentially receive that benefit of the small business deduction. Also, what can happen is it's very common for a business, a corporation, to also, say, own the building they operate out of and have a couple of tenants. Or maybe they have earned a lot of income and have extra cash and decided to invest it to kind of keep it safe for later putting back in the business, or saving up to buy some equipment, or whatever reason. That incidental property income, which is really tied closely to the business operations, those will be treated as active business income. Interest and rent will be considered part of the overall active business income, as long as they relate to the business itself. And lastly, income from one of those associated corporations that deducted the amount, that will be treated also as active business income. So if it's an associated corporation, comma, that corporation deducted the same amount, then we can treat that as active business income because it came out of the other corporation. So let's talk about the calculation. How do we actually go about this? We looked at it very simple. We just said, okay, it's 19%, 19 times 100, easy. Well, we have to do a little more specific. The calculation can get a little more complicated. So in section 125.1, subsection 125.1 specifies the deduction as a 19%, that's the current rate, of the least of. And we have 1, 2, and 3. So it's a good old one of these. Calculate 3 different things, pick the smallest. Tax Act loves these. This is how it gets things done. So you'll be familiar with these by now. So the 3 items are net Canadian active business income. This is how we limit it. Right? The purpose of this funky calculation is to limit it to active business income only. So we're going to, in other words, this 19% is only applicable to the least of these 3. So Canadian active business income, so that will force through the removal of any property or investment income other than what we mentioned here, incidental. Number 2, taxable income itself, less 100 over 28 times the foreign non-business tax credit. These 2 here, 4 times the foreign business income tax credit. We're not going to get too deep into this stuff. So this is foreign non-business, and this is foreign business. These numbers will just be given to you. Just crunch them into the formula. We're not going to get too detailed into this stuff here at this point. So taxable income, so we know what taxable income is, right? We talked about our net income for tax minus a few more deductions gets us to taxable income. So just less some of this stuff related to tax credits. And number 3, your annual business limit, 500,000. So you'll notice that basically what this formula does is limit us to the lower of our active. So we're not going to include things that aren't active, taxable income itself, and the business limit. So we'll never be able, based on this least of, we'll never be able to go over the business limit. This is the business limit portion that's allocated to our corporation specifically. So often that'll be 500,000, but if you have an associated group, then it might be less. So a question would tell you, ABC Co. is part of an associated group. They are allotted 125,000 of the business limit. So you have to remember when you're doing the question, not to always just plug in 500. You might have to adjust and plug in 125 instead. Then you pick the lowest of those 3, and then you multiply that by 19%. and put that in a row in your overall calculation. Now, there's a little bit more for that. That is how we calculate it. However, there is a potential reduction to the small business deduction. So this is going to potentially reduce how much you get to claim. So we have a couple of things going on. So one, if this is not a qualifying corporation, meaning if this was a public corporation, it just doesn't qualify at all. Don't bother doing any calculations. If it is, you're right, so we had back here, CCPC. First off, if you see the question, if it's public, no go. Technically, if it only has passive income, then you're going to get to zero. But really, the CCPC thing, if you're public, you just don't qualify, don't bother running any numbers. Once we get in, these calculations are going to reduce your situation based on sharing, based on if it's active income or not. This will work the math out for those things. So if it's public, don't bother. Everything else, it'll work itself out through these calculations. But there's one more calculation which will also work itself out, which is based on this is a reduction, which is based on something called, and we'll come back to that slide, taxable capital employed in Canada. Depending on this number, you will get a certain amount of reduction, potentially, you may or may not, and potentially all the way to putting the whole thing to zero. So we can have a look at that calculation. But first, let's define taxable capital employed in Canada. This is the taxation concept. So what this includes is your GAAP, so your accounting determined debt, equity, less any debt or equity you own in other corporations. So if you have an investment in another corporation, it offsets. So taxable capital employed is all the debt you have and the equity you have, right? So when we're trying to raise capital for a company to get a business started, it's going to be some sort of a mix of, well, either equity, there has to be some equity and debt, or just equity, I suppose, if you didn't know that. So often, though, it's going to be a mix of debt and equity. Those together, minus anything you've then transferred to another company, that's your taxable capital you're employing to go get the job done. This will be part of what will determine if you are a large corporation. So when we say small business deduction, we are not basing the small on how much income you earn. We are basing it on how much capital is being employed in Canada. That's what we mean by big and small, small, large, whatever you want to call it. So basically what happens here when we run this calculation, if your capital is less, and by the way, this is taxable capital employed in Canada. It says when not all of the corporation's taxable income is allocated to a province, the resulting amount is multiplied by the same percentage that is applied to the abatement in order to determine the portion of the capital that is employed in Canada. So that you do that same kind of math that we looked at before if some of this isn't. But let's assume all of it is, and the number is 10 million. So when the taxable capital employed in Canada is less than or equal to 10 million, no reduction. So this is a pretty big number. So as long as you haven't raised debt and equity in a total of 10 million, to carry out this business, you will qualify. So no reduction. You will qualify fully, I should say, with no reduction. When you reach 15 million, you will have a 100% reduction, and effectively, you will get no small business deduction. In between 10 and 15 million of taxable capital employed in Canada, that's when you will have some amount of a reduction. So this reduction is calculated by this formula right here, A times, in brackets, B divided by 11,250. So A is your business limit, and B is 0.225%, in other words, 0.00225, of the excess taxable capital employed in Canada over 10 million. And just as a side note, this is for the previous year. It's not this year's number, it's last year's number. So you would basically kind of get that from your balance sheet at the end of the previous year. It's effectively what you started the year with, not what you ended the year with, because you could have gotten some of that money right at the end of the year and you haven't employed it yet. So they're just picking a point. It makes more sense to pick start of the year. What did we report at the start of the year, which is the same as the end of last year? So that's what this all boils down to. Up to and including 10 million, you'll have no reduction. Between 10 and 15, you'll have a reduction based on this formula. And then when you reach 15 million, mathematically, you will have fully reduced to zero. So if you're 15 million or over taxable capital employed in Canada the previous year, you will effectively have no small business deduction. So keep those things in mind when you approach questions so that you can know how that's all going to work out and how those numbers are going to be crunched. I think I'm going to just go ahead and stop there. So it's about 7:34 now. We've got some other descriptions here, manufacturing and processing. I'm not going to get into too much detail here on these tax credits and things. Yeah, there we go. So now's a good time for us to shut down the slideshow here, and I'm going to bring up a practice question. Let's see here. So in this document here, there's a few of the problems from the back of the text here, and we're going to see what we can find time to kind of get through here. But I will post this document up to Brightspace for you guys tonight so that you have this. Now, we just talked about this calculation. There we go. So assignment problem 12.9. This one is an example of calculating that federal tax payable. So since we just talked about that, why don't we dive right into one of those? So this is in the textbook. This is what we're going to do in class. We'll go through questions from the textbook. So have either your physical textbook or your online one handy, and we'll kind of go through questions. Again, we're not going to go through every single question in the text. I'm going to highlight the ones that I think are the most important, considering our limited the time that we have. So we're not going to do every single example of every single question. I'll focus you guys in on the type of question that you will need to be able to do for the assignments and the midterm, etc. Did somebody have a question there? I thought I heard somebody come on the mic, but I didn't catch it. No, if anybody has any questions, feel free to jump in. So this question that I want to run through, it's assignment problem 12-9. It's at the top of page 626. So this question is asking you to calculate taxable income and Part 1 federal tax payable for the company Lorne Inc. for 2020. No problem, Odessa. I actually earlier just closed the whole thing on myself. Just closed the whole thing and had to go back in. So we are on page 626, and we're going to run through problem 12-9, and that is a question where we're going to calculate taxable income, a basic little taxable income calculation, and federal, what we call Part 1 federal tax payable. So we've got the question up on the screen here, and we're going to run through this example. Or sorry, we have the solution up on the screen. So I'll read a little bit from the question. It says, for the taxation year ending December 31, 2020, Lorne Inc., a Canadian-controlled private company. So as soon as you read that we have this company here, whoops, forgot to switch to a pen. This company here, you guys know I love to scribble. This is a CCPC. So we know right away when we hear that, we're gonna need to evaluate about the small business deduction. Maybe they qualify, but then don't because they get reduced, or who knows. But we know we need to look at it. If it was a private corp or not a Canadian corp, well, then we're not worried about it. That's right. If it's a public corp, we're not worried about it. I think I misspoke there. But for Canadian-controlled private corporation, that's what we're talking about. So we have net income for tax purposes of $340,500. So that is given in the question. That's that number where we would have had accounting income, do a bunch of adds and subtracts, and we would have arrived at net income for tax purposes. That's still something we're going to need to learn how to do. We talked about that already, but we'll practice that as well. But in this case, we've been given that number. So we just need to get between that and taxable income. Now, that income itself, we are told, is made up of $312,400 of active income. So 312,400. Geez, doing very good scribbling here. 300. All right, turn the whole screen off. So 300, what do we say? 312,400 of ABI, active business income. There's a little bit of passive involved here. What else is included in there? 28,100 of dividends from various Canadian public companies. So Canadian public companies, 28,100. It's been determined that 211,300 of the active business income also qualifies as manufacturing and processing profits. So we had that short list of items that we would deduct in between net income and taxable income. So we're going to need to read on a little bit more here. We're also told that during 2020, the company makes donations to registered charities totaling $31,400. So there we go. So we've mentioned both of those, right? We had $28,100 of dividends from Canadian public companies. We are going to deduct that because they are Canadian. The public part doesn't make any difference. They're Canadian, so they're being taxed in Canada, so we can deduct. The charitable donations, we will always deduct here when getting to taxable income. Remember, it was weird with the donations. We actually added them back to get to net income for tax purposes. Like they would have been on your financial statements as a deduction. We added them back to get to net income for tax purposes, and now we're subtracting them again. The donations are a deduction, not a tax credit for corporations. Then we're also told at the beginning of 2020, the company has a non-capital loss carry forward of $29,300. We're also told the intention with this, because when you have loss carryovers, it's up to you what you want to do with them. You have some choice. You can use some strategy. These are non-capital losses. So we talked about this last class. With the non-capital losses, we can apply them against anything. We're not limited like we are with the net capital. So non-capital, which is your everything but capital, we have $29,300, and we're told the intent. The intent is to deduct all of this carry forward stuff that we have in this year. We're doing 2020. We're going to deduct all of it. So there's our deduction. This is the spot where we take the deduction. So the dividends are gone because they already had Canadian tax. The donations are gone because we just haven't deducted them yet. They are a deduction, not a tax credit. And the non-capital loss carry forward is gone, meaning we're using it because it's our intent to use as much of it as possible to clear out the tax. So pick up where we left off. So you've got your net income for tax purposes. We have a few deductions. We have to evaluate each of those, take them out to get to net income for tax. We just ran through those and why we used each of those. So we have achieved the first goal, which is to calculate taxable income. So just like personal tax, you've got net income for tax, you've got taxable income, and then that taxable income is what we use to multiply against our different tax rates. But instead of brackets, we have this funky system here. So step number one, we're going to go at it with the highest rate, the full tier, full freight, the most you could possibly pay, 38%. We always start with that. You're going to have that every time, no exceptions. We start there, worst case scenario, right? So let's pick the scariest number. You owe 95 grand. Then we're going to slowly claim every reduction that we can in that rate. And they're going to all have funny different names. Some of them are called reductions. Some of them are called abatements. Some of them are called deductions. They're all going to reduce how much you pay for tax at this point. So the first one is our federal tax abatement. That is the 10% that is meant to give you, out of the kindness of their heart, give you a little room to pay provincial tax. So you have to have earned the income in a province that's charging you their provincial version of the tax. It's always 10%. Doesn't matter which province. It's not literally matching up to the provincial rate, but it's meant as kind of a placeholder for that. And it's just sitting at 10%. So in this case, we do know that we have earned all of that income, right? The whole $251,700 has been earned in a province. So we don't have any issues there. We don't have to reduce any. If some of this income wasn't, then we would just multiply the 10% by a different number. So if only 100,000 of this was earned in a province, it'd be 10% times 100,000. But in this case, we're good. It was all earned in Canada. And also, if the question doesn't tell you that it wasn't, you can just assume it all was. You'll be given specific details that say this wasn't. In the question, it says, as the corporation operates in a province that has a reduced tax rate for M&P activity, a separate calculation for federal M&P deduction is required. So it kind of tells you there that there is a province, and also highlights some specifics about manufacturing and processing, which is another one. So we did the base, we did the federal based on what province we're in, and then the next one up, so we did that. The next one up is going to be our small business deduction. And again, you're showing the dollar amounts. You're not just doing all the percentages, because it's not just a percent of the one number. Each individual has to be dollar amount, because some of these, the base amount could be different that you're multiplying the percentage against. So don't ever just go 38% minus 10 minus 19. That could be how it works out, but don't shortcut it, because you could make a mistake. Whenever you're answering the questions, try to use a similar kind of structure that you're seeing in the sample solutions. Makes it the easiest to make sure you earn all your points. So manufacturing and processing, like we mentioned before, in some cases can have a special reduction applied for that to promote manufacturing and processing, because in theory, that takes a lot of people. If it's not all done by machines, that takes a lot of people. And so it's going to be good for the economy, create jobs. Now, the reality is that as of right now, that reduction or deduction, whatever you want to call it, really has little effect in the big picture. It could on a provincial level, but it's really not a major deduction from the federal standpoint, meaning the general rate reduction of 13%, the manufacturing and processing reduction or deduction is also 13%. And you don't get to have more than one. These three right here, the income dollars that you're using on them, you don't get to double up. So you can have some applied here, and some applied here, as we have, but you can't double use the base number. So in other words, all of these together can only be using some portion of 251,700. So that'll be a little more clear as we look at, you see there's notes for each of these calculations. But you can't overlap. That's so no overlapping, no double counting on top of. This isn't 13 plus 13 plus 19. It's some of it uses 19, some of it uses 13, and some of it also uses 13. If they change the manufacturing and processing deduction to say 15, well, then that would have a bigger impact. Now, in this question, it mentions that the corporation's in a province that has a reduced rate for that. So we're just going to assume, and you're only doing federal calculation here. So we're just going to assume that this matters. But ultimately, it's not going to change the bottom line in this calculation. It's kind of like this thing is there, but it's currently not mattering. But again, they can change those figures. They could tell us next year that the general rate reduction is 14%. Or M&P is 18% now. Like, these could change. So we have to continue learning the calculations and doing them, even though they might not change the answer. So in other words, you could calculate your federal tax payable and get the right bottom line answer, but not have allocated these portions correctly. and you wouldn't earn all the points. So make sure that you don't forget how much belongs to M&P, how much belongs to general rate, how much belongs to small business deduction. So that's my spiel on that. But let's keep going with how do we calculate those pieces. So this is where we get a little bit of a trick to the question, right? A little bit more detail. So first off, let's calculate that small business deduction we've been talking about. So the small business deduction is going to be based on the least of number 1, number 2, and number 3. That was active business income, given in the question. Taxable income. We didn't have any foreign tax credit adjustment in this question, so you don't got to worry about it. So it's just taxable income. And the annual business limit. So remember, generally that would be 500, but if you're sharing it with associated companies, then we have to use a lower amount. In the question, let's see somewhere here, it said the combined taxable capital employed in Canada. So let me read this from the top. It says Lorne Inc. is associated with 3 other CCPCs. The companies have agreed that each company will claim I think they may have boo-boo here. Oh, no, that makes sense. Yeah, so Lorne Inc. plus 3 others. My bad. So there's 4 companies in total. So Lorne Inc. plus 3 others, that's 4. Those companies have agreed to evenly split this 1/4 each. So we're simply taking the 500,000 and dividing it by 4. Each of them has the possibility to use 125. It tells us that the combined taxable capital employed in Canada, and it is combined. If you have associated, you also have to combine that number. It tells us that it's less than 10 million. In both 2019 and 2020, we are calculating 2020 tax. The only taxable capital employed in Canada that matters to us is 2019. So watch out for that trick in a question. If it tells you what it is in 19 and in 20, use 19 or whatever that previous year is. In these cases, it's going to be 2019. So it tells us that it's less than 10 million. The threshold is that between 10 million and 15 million to get reduced, and over 15 million, you're not going to have any at all. So we know that we don't have to do any special calculations because we're under that 10 million. So there's no reduction. So we can go ahead, pick the lesser of these 3. So ding, 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 the winner is 125. We take 125, multiply it by 18, and that's how we get our small business deduction. So it's going to be 23,750, and there it is, being subtracted from our overall calculation here. So far, so good. Any questions there? Calculate the 3, pick the lowest, make sure you qualify, make sure you get the annual business limit correct, make sure that if there is or isn't a reduction, and how that's going to affect the overall calculation. So now let's move on to the next piece. Manufacturing and processing. This only matters if you have manufacturing and processing profits. And it only matters to the extent that you have that. So let's have a look at what it said in the question here about that. It says, it has been determined that 211,300 of the active business income, because manufacturing and processing would be active, qualifies as manufacturing and processing profits. So 211,300. Now here's where the trick comes in. We can't double dip here. We've already used the 19% on 125,000. So we have to deduct how much we already used for the small business amount. Now the ordering of this is you do the small business deduction first, then the manufacturing and processing, then you do your general rate reduction last. The GRR is always last if there's anything left. Manufacturing and processing, if there's anything left. If we had done the manufacturing and processing number, if we had done the small business deduction number on 500,000, we would have none left to use, right? Because 211,300 minus 500 is negative. There's nothing left. We're done. But in this case, we were limited and we only used 125,000. So we have 86,300 remaining. So, sorry, I should take a step back. I kind of jumped ahead here. So the base for the manufacturing and processing deductions, this is also a lesser of. So that's going to be your M&P profits minus the small business deduction amount used, or taxable income itself minus the small business deduction amount used. But it's always the lesser of. So in this case, that's going to be the 86,300. So you have to do this little calculation. 1, we did small business deduction. 2, we do this little one for M&P. Now, when we get all the way to the end, to the GRR, because again, we can't double dip on these three, we're going to use the GRR on whatever's left. So our taxable income that we're working with, our base number is 251.7. We used 125. We applied the small business deduction to. We used 86,300 calculated here in order to do the M&P deduction. That leaves us with only 40,400 left to use the GRR on. So our general rate reduction will calculate as 5,252. And by the way, I think I skipped over it here. It was 11,219, right? The M&P rate is 13% of the 86,300. So 86,300 multiplied by 13% is 11,219. So 11,219 is how much we deduct here. Then our general rate reduction is that remaining 52.52. So we were doing 3 steps. We figure out how much our base is for small business deduction. Then we figure out our base for the manufacturing and processing by reducing it by what we already used in small business. Then we figure out the GRR by taking the total, reduce what we used small business, reduce what we used M&P. We have 40,400 left. That's the last little bit. So this whole income is getting something. It's just being broken up into 3 parts. A little bit of it's getting the 19% for small business. A little bit of it's getting the 13% for M&P, and a little bit of it's getting the 13% for GRR. Yes, it's 13% in both cases here for M&P and GRR, but you have to allocate it specifically to those categories. Those rates could change. There also is a potential provincial component that could be different. Federally, right now, bottom line, it makes no difference, but you still have to categorize it correctly here. So make sure you're careful with those calculations. Are there any questions? So I'll just to summarize here. So we have our base minus our federal tax abatement, minus our small business deduction, minus our M&P, minus our GRR. All of those gets us to our actual, what we call Part 1 federal tax payable. That part 1 is what we're learning about in chapter 12. There are some other federal tax situations. We'll learn some other ones in chapter 13. How are we doing? Here's a poll. Did that make sense? Feel free to be honest. No penalty for honesty here. Honesty helps. I got 6 out of 9. Three of you already gave up on me. All right, I'll take that. I'll take that. As a positive. So this is making some sense. So that's the type of question that you could expect to see on the assignment, on the midterm. Calculating that. Now, I see it's about 8:05 now. We can continue. There's a couple more sample questions, and I'll post this whole solution for you guys. There's a couple more that I do want to, I think we can kind of call that enough for tonight, but there's a couple more that I do want to run through. You guys have an extension there on the assignment, so we're not in a big rush, so we can pick this up next class. So we've got 12 dash. By the way, too, we won't spend the entire class on chapter 13 anyways. Chapter 13, which is our next one, is a little abstract. So don't be discouraged as you're reading it if it just kind of not sinking in. I'll try to focus on a few specific, just mechanical number crunching. Here's what we need to do. It's adding a little bit, like another wrinkle to this corporate tax calculation that we've learned here in chapter 12. It's not the most exciting chapter. Some parts of it we'll kind of leave out and we won't get too deep into, but we'll do some of the basic calculations. So we won't spend the entire next class on it anyway. So next class, at the beginning of class, we'll pick up with a couple more problems from chapter 12. One of them is 12.3. We'll have a look at that next class. This is where we're doing all of our adds and deducts that we were talking about. So we're going to practice getting to net income for tax and some of the little rules along the way we might have to deal with reserves and bonuses and stuff like that. You guys might remember there was some rules around bonuses back in tax 1. So some of that stuff's going to kind of pop back in, rear its ugly head again. Hopefully, if you remember, but it can refresh back from tax 1. We are building on our knowledge. So that's stuff that we learned back in chapter 5, chapter 6 about business income, CCA. We will utilize that a little bit here. So some of that will kind of pop back in. Like in this question, there's some CCA calculations required, right? Because we're adding back amortization and subtracting CCA. What else do we got? I'm going to go back to number 1. And then there was also problem 12-2, which is really just a little bit about calculating taxable income. A little more basic here, just to kind of run through the steps of getting to that. So just a little bit of practice there to carry forwards again. So at the start of next class, we'll crunch through a few of those questions, and then we'll get into chapter 13. As far as anything we haven't covered yet in chapter 11, we might even have enough time to do that next class. Either way, if we don't, anything we don't get time to do in class, I'll try not to do that. We'll try to fit everything in class, but if we do ever run out of time, we'll pull together a little side lecture for a specific topic or practice question if you guys want that extra stuff, if we need the extra time. But I'll try to keep that to a limited amount. So that is it for tonight, and that is the plan for 1 week from today. If you guys have any questions, anything, let me know. Keep your eyes peeled for assignment 1. I'll get that posted real soon for you so you can start working on it. Again, it's on chapter 11 and chapter 12. So you guys have most of everything you need for that now, but we'll cover a little more of it at the beginning of next class. And I might throw something at you in the meantime if I can pull that together. But we'll get you all geared up for assignment 1, and you have an extension anyway. So good news. If you haven't submitted your court case summary, I'm sure you'll want to get back at that and get that in now. All right, guys. Have a great rest of your week, and we'll see you next Tuesday.